Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Wall Street ends the day in the green. All major indices did finish higher as investors watch revised labor data. We're looking back at the highs and lows of Wall Street with a deep dive into an infamous crash, and Tesla expanding its battery business. We're looking at what investors can expect there. Well, we're on the pulse of the retail investors. Charles Schwab is out with its monthly trading index rising in August. Overall, pessimism was up, but traders were buying stocks as volatility was muted. Joining now, we have Joe Mazzola, Charles Schwab head trading derivative strategist. Joe, always great to see you. You always have such good line of sight, Joe, into how investors are feeling right now, given all those many Schwab customers. So, what are you hearing? What are you seeing from those customers, Joe, in terms of just broadly how they feel about the market? Are they optimistic, Joe? Are they pessimistic? What do you see?
Well, Josh, we can break it down two ways. We can break it down from what they're doing and what they're saying. And sometimes those don't always align. And in this case, they don't. So what they're doing is they're buying, and they're buying pretty handily. I would say that this was the biggest jump month over month that we've seen in the last 5 months. Actually, the biggest jump really since February. So we don't always see it where the stacks itself has a higher percentage gain than the S&P 500, but that was absolutely the case in August, as you had a flattish market, right, about a 1% move in the S&P 500, but the stacks was up almost 5%. As you were just talking about with the Oracle earnings, it's still AI that's kind of driving the trade here. NVIDIA, Palantir, those are two of the three biggest buys. UNH, maybe one is not like the other, right? That was the third, but we also saw a lot of buying momentum in Amazon and in Microsoft. So 4 out of those 5 are either some type of AI or AI ancillary players.
To the extent, Joe, they talk about feeling more pessimistic, at least, what's on their radar of concerns? How come?
Yeah, it's really there's two things. It's a macro concern that's really around tariffs, trade policy, and then what was really interesting is anecdotally we heard some concerns around Fed independence. So I don't know if that's news driven, but that was something that was called out specifically by our clients. Then the other thing is really more of a micro concern, and that's just valuation, right? I heard your last guest talk about the fact that valuations aren't the same as what they were in 2000. We get that. Makes a lot of sense because you do have companies that are continuing to drive earnings, and earnings estimates have been going up. And so I think, can the market continue to go up and climb a bit of a wall of worry from an attitudinal standpoint? Absolutely, it can. But I think that there's a little bit of concern as seasonality was something that was mentioned as well too. But just because they're saying it doesn't necessarily mean that they're doing it, and we continue to see buying.
Joe, did you spot any generational differences, I'm curious, among those customers in terms of how they feel about the market?
Yeah. I mean, it's funny. It tends to skew the older meaning Gen X. Man, I can't believe I'm saying older at this point as I'm Gen X, Josh. But yeah, I guess that's true. We were a little bit more bigger buyers than maybe some of the other generations. We also saw that with the millennials as well too. They tend to take on a little bit more risk. This didn't show up necessarily in the top 10, but what I thought was interesting is this is the first time that we're seeing some of the meme names creep up in the top 25. I know you guys had asked about that earlier, but yeah, Open, was one of the names that showed up on the list. We've seen a lot more kind of cryptocurrency and cryptocurrency adjacent, I'm going to use that word again, whether it's a MicroStrategy, a BitMine, some of those different names that are investing specifically in Bitcoin or in Ether, and gives the clients the opportunity to kind of invest through different companies like that. So those are names that are kind of creeping up on that top 10, top 20 list that we just haven't seen we haven't seen in the past, and those are more.
What do you make it? What do you make of that, Joe?
Yeah, what I want to say is that clients are stretching a little bit, and I don't necessarily know if that's true, but I do think that they're taking opportunities to kind of look for some additional beta look for some additional alpha and beta at the same time, really, right? Look for some more volatility and see if they can participate in some of those upside moves, because some of these moves have just been incredible in terms of some of those smaller names. And I think, Josh, when you look at the best performing, not necessarily sectors, but if you break it down by baskets, and this is something that we've been talking about quite a bit recently, go back to that April sell-off that we had, the April bottom, and you look at some of the baskets, whether it's net short stocks, whether it's non-profitable tech, whether it's retail favorites, those are the ones that have outperformed. Will it stay that way? Probably not forever, but they're riding the wave right now.
Anything to call out the options market, Joe? Any trends, themes you'd want to highlight?
Yeah, we're just not seeing a lot of hedging, Josh. People just aren't very concerned about the downside moves. And as I mentioned a little bit before, sometimes it makes the spidey sense go up a little bit, and it does make me a little concerned when I look at kind of the seasonality where we're at right now, and the fact that you're just not seeing a lot of hedging from the institutions. Now, what you are seeing from the institutions, and I thought that this was interesting, if you look at the future side, so equity futures, we're seeing net short positions with some of the institutions out there, and they're using the cash that they're raising from the short position, the equity futures, to buy fixed income futures. So there's a bit of a rotation there, but you haven't really seen it nearly as much on the retail side. They just continue to stay long. Joe,
always appreciate your time. Thank you.
Thanks, Josh.
Stick around. Much more Ask for a Trend still to come. Tesla is expanding its energy storage business, revealing 2 new products. Yahoo Finance's Praz Subramanian joins us now with the latest. Praz.
Yeah, Josh, I had an event yesterday in Nevada talking about their battery plant there, and they revealed the new sort of Megapack 3, which is their latest kind of commercial utility battery storage unit there. It's basically holds more power than the old one did, better efficiency, things like that, so you get more sort of energy out of a single cell. But most interesting is a thing called a Megablock, which is this thing that combines 4 of these Megapack 3s into a whole, essentially a system that can deploy and take in power. It's got a built-in transformer and switchgear. Basically, you can deploy it at a city, and you can basically put in power there when you need to, and then discharge it when you need to, let's say during peak time. So it's a way to sort of balance out the curve of power usage the tax grids when you have things like electric cars being charged and things like that. You want to bring in that solar power, keep it charged into the batteries, and deploy when you need to.
Doesn't Musk talk about this storage business as part of his master plan, part 4?
Yes, we had part 2, part 3, part 4, but excuse me, yes, energy storage, part of the whole sustainable energy solution for the whole globe, right? Part of that is you have to be able to store renewable power somewhere, because you have wind power, you have solar power, it comes in the grid, but what do you do when you have too much power? Where does it go? You got to store it somewhere, and then when it's nighttime, no solar power, so you got to deploy it. So that's part of the whole thing. And for Tesla business-wise, just real quick business-wise, it's a small business compared to its gargantuan auto business.
Bread and butter.
But it's growing, right? As the auto business fell, I think 16% auto business revenue fell in Q2 year over year. The deployment battery storage revenue went up. But most importantly, gross profit and the margins are very good in this business.
All right, thank you, Praz. Appreciate it. Time now for What to Watch Wednesday, September 10th. Starting off on the economy, fresh inflation data coming in on Wednesday with PPI, that's the Producer Price Index. Economists forecasting both total and core PPI to slow to 0.3% on a month-over-month basis. The move signaling that inflation is decelerating. And for the Fed, softer inflation prints could increase the odds of an interest rate cut at the next FOMC meeting. Taking a look at earnings, Chewy announced results for the second quarter before the markets open on Wednesday. Analysts forecasting sales of the pet food supply company to grow 7 to 8% in Q2, driven by Chewy's auto ship program, the catalyst for retention and stability, which analysts are expecting to account for over 80% of Q2 sales. And moving over to housing, weekly mortgage rate application data is coming in on Wednesday. Applications have declined for the past 3 weeks, suggesting slowing demand in the housing market amid elevated mortgage rates and home prices. Stick around, much more Ask for a Trend still to come. The 1980s bull market seemed unstoppable, but in October 1987, that optimism unraveled in a single day, now infamously called Black Monday. Trader Talk host Kenny Palkari sat down with John Parasco, former managing director at JP Morgan Chase & Company, about the crash.
There was a confluence of events that took place leading up to the crash. You had international agreements like the 85 Plaza Accord of G5 nations. The idea of that was to stabilize the dollar and put a floor underneath it. Then came the Louvre Accords. That was attempting to adjust currencies in a specific trading band. That's tantamount to sticking your head in the lion's mouth and hoping he doesn't bite down. Because the currency markets are known for their volatility and they trade amazingly deep.
Right, but these two accords happened during the summer into the fall of 1987.
Well, the Plaza Accord was in 85.
Okay.
And then the Louvre Accord came early 87.
Early 87.
Yeah.
Okay.
So that didn't work clearly. From January to September, the Fed started tweaking rates higher.
Right.
So there was a lot of concern. The market being up 40% already, and
that year alone, it was already up
Right.
250%.
Right. You had the bull run from 82 to 87.
Right.
776 in the Dow to 27 and change.
Right.
So, things were ripe for volatility. Up 40% and having a diverging bond market.
Right.
The bonds were not going along for the party at all.
Right. And there was kind of building global economic weakness, really, as I remember, right around the world. Asia, Europe,
Right.
the U.S.
Right. So you had the overvaluation, the widening trade deficits, the declining dollar was a concern, and the selling pressure really started to mount the week before the crash.
Wednesday, Thursday, Friday.
So on Wednesday, October 14th, you had the House Ways and Means Committee come out, and they introduced the bill to limit the tax benefits on LBOs. That was a dampening effect. Then you had the Commerce Department issued trade deficit data that was way above expectations. Market wasn't happy. The sell-off starts, and we're down 4% that day.
Right. And it's funny because on the Wednesday, Thursday, Friday, as the selling started, we sold off, we had significant sells, and we closed on the lows each day, which never sets up very well for the next trading day.
Thursday, the sell-off continues. We're down another 2.5%. That's followed by a down 5% shot in London.
Right.
Coming into Friday morning now, you have triple witching that Friday. Expiration of the options and futures, enhanced volatility like we needed it. Market's down 4.6% that day, so we're down 10% for the week.
In 3 days, we're down 10%.
Right.
Which was a huge move. It's a huge move anyway, but it's a huge move then in 3 days.
So you expect people are going to exhale over the weekend, reassess. Wrong. Saturday, Treasury Secretary Baker issues some comments hinting that he might want to devalue the dollar instead. Foreign investors get really rattled about the prospects of a currency war.
Right.
Over the weekend, certain mutual funds back then allowed customers to redeem their shares at Friday's closing prices.
Okay.
You come in Monday morning, the prices are vastly different. Now the mutual fund complex has to sell many more shares to have enough cash on hand to redeem those shares.
Right.
So that's even more selling.
Right.
So that Friday, I take home a 20-year chart book. And on the top of the list, I write prices I hope I never see. The object of the exercise was to have a quick reference and 3 deep levels for my most liquid big cap stocks.
That you were trading.
That I was trading in anticipation of deep institutional liquidity needs on Monday.
Right.
So the object was get in early. I get in at 6.
Right.
The biggest concern I had was getting to the men's room, getting back to my seat, and strapping in.
All right, wait. Hold that thought 1 minute, because I just want to. Now, here's me. I get up. I go to bed Sunday night at 9 o'clock. I get up at 4:30 on Monday morning. I'm oblivious to what's happening around the world. I take a shower. I get dressed. I get down to the train station. I grab my coffee. I grab the Wall Street Journal. Well, Monday's Wall Street Journal is telling me what happened on Friday. It's not telling me Monday's already passed in Asia. It's already Monday morning in Europe. and it's still, it's still dark here in the United States, right? And so I come to work completely oblivious because there's no internet, there's no Bloomberg on the floor, there's no television, no radios. I have nothing but the newspaper. I'm sitting on the floor, 7 o'clock in the morning, drinking my coffee, going through my tickets, and then the phone rings. You take it from here.
Well, clearly the world was blowing up overseas. Hong Kong was a mess. And I felt it was critically important to have the floor brokers all on the same page. So I wanted them to understand my mindset and what we were apt to face. So I told you that the world was absolutely blowing up.
Well, you picked up the phone, you said to me, hey bro, what are you doing? I'm having my coffee. And you said to me, do you have any idea what's going on? And I go, no, what's going on? Okay, go ahead.
So I told you that the world was on fire and it was blowing up. And
I honestly did not understand the depth of what you meant.
So at that point, everybody had a pigeon and a note strapped to the pigeon's foot, so communication was vastly different than it is today.
Vastly different.
So the conversations started early. I had a good group of floor brokers, and then I had 3 ninjas, as I like to say, the special forces. And Kenny, you were one of them, obviously.
The special force.
Your ability to communicate, your relationship with the specialists, and most importantly, you were smart.
Let's take a look at what's trending after hours now. Shares of GameStop, they're rising. Company reporting second quarter earnings and beating analyst estimates for hardware and accessories and net sales. That coming in at $592.1 million, 31% increase year over year. Company also reporting its Bitcoin holdings are valued at $528.6 million at the close of the second quarter, as well as announcing a dividend of warrants to shareholders, which would expire in October 2026. Synopsys shares, they are sinking after reporting its third quarter results. Company saw strength in design automation offset by weakness in design IP. Looking ahead, the company's fourth quarter earnings outlook falling short of Wall Street's expectations. Full year adjusted earnings per share guidance also missing estimates. And finally, Rubrik topping revenue estimates for the second quarter. Subscription revenue rising 55% compared to the second quarter of fiscal 2025. Company's CFO highlighting results of the second quarter driven by healthy new customer acquisition, robust expansion, and increased efficiencies in the business. Rubrik boosting its subscription annual recurring revenue guidance for the full year, while also lifting its guidance for full year revenue and free cash flow. Well, that's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.